Now it's time to bring in our next guest, Mike Burleigh, president of Peak Capital Management in Jensen Beach, Florida. Mike has over 30 years experience helping people learn to plan and save for retirement. Mike also is one of our initial group of retirement income store members. Mike, thanks so much for being here with us today.
Thanks for having me, Dave.
You're very welcome. Now you and I are pretty good friends. We talk all the time about various things, so I know a lot about your philosophies and even some of your experiences that you have. Today we're talking about RMDs. Tell our viewers, if you will, what are some of the most common misconceptions that you find people have when they walk through your door about required minimum distributions and what they really are?
Well, typically they don't even know what they are. We find that quite frequently. So the questions we typically get are what are these things, these RMDs? And of course, the next question is, well, when do I have to start taking money out of my retirement accounts, and then how much do I have to take?
Mm-hmm. Now, it's interesting. The new tax law has, I think, helped most people. It's hurt some people in terms of paying more tax, but for a lot of people, it's helped them. Your average family today making $100,000 or so, married filing jointly, is only in the essentially 12% tax bracket. So have you started recommending more Roth IRA conversions than you have in previous years in light of the lower tax brackets, or talk to us about that?
Well, it kind of boils down to each individual case, and it kind of depends on how far they're away from having to take these RMDs. You know, if they're maybe 5 years out, we can kind of look at some Roth conversion strategies over the next 5 years. When they get a little closer, a lot of people, you know, when they see that tax bill, if they want to convert it all in 1 year, it's a pretty big check in some cases, and you know, they look at that and they simply just don't want to write the check to the IRS. They'd rather take it out over time.
Do you think enough people are taking advantage of the ability to send those minimum distributions off to a qualified charity so that they could essentially get those minimum distributions tax-free?
Well, we actually had a client in last month that's actually doing that. You know, if you don't need the money to live on and you're able to send that off to a charity and get that tax break, you know, it makes a lot of sense for some people if they're in a situation to be able to do that.
Now, you probably get some people like me that say, I want to know how to invest these minimum distributions. They're coming out, I'm forced to take them. I want to do something valuable with them. In the 30 seconds we have left, what do you tell those people when they want to know what to do with the RMDs once they take them?
Well, you know, one strategy, you could create an estate for your children. You could take these RMDs and maybe set up a 10-pay life insurance plan. Pass those assets to your heirs tax-free. You can simply reinvest some of that money in maybe a tax advantage situation. Tax-free municipal bonds, potentially, tax defer that. You hate to pay tax on them money twice. Or you can simply spend the money on vacations and travel and enjoy it.
Speaking of fun, we have to take a commercial break. Mike, don't go away. We'll be back here with more in a moment on the income generation. I'd like to welcome back my good friend, Mike Burleigh, president of Peak Capital Management in Stuart, Florida. Even though we're good friends, just during the commercial break, Mike told me that I guess I didn't realize they had already made the move. They ran out of office space. They needed a bigger office. They made the move to Stuart, Florida. Mike, thanks so much for sticking around.
Thanks, Dave.
I want to, it's funny, that question I asked you right before the break is about, saving those RMDs, what to do with those RMDs to make them productive. But sometimes I think people miss the point, because a required minimum distribution is less than 4%, at least when you start taking them, of the balance. So if you have $100,000, the RMD is $3,700. But people are worried about protecting and doing something effective with the $3,700, but sometimes they forget about doing something productive with the $100,000, with the actual lump sum that's in the IRA. So people always hear it from me. I know your philosophies, we talk all the time, but tell our viewers directly, what's so important about the asset allocation, about your investments when you're getting ready to take RMDs, in your own words?
Well, for us, the most important thing about these required minimum distributions that you have to take out of these accounts. You're mandated by the federal government to take them out at 70.5, is to take them from interest and dividends. You want to take them from earnings. You don't want to have to liquidate or sell part of your savings to take that required minimum distribution, because down the road you could potentially run out of money. So the key is to take that from income. So you have to make sure that you have enough income in that retirement account to pull those RMDs out. Typically a stock portfolio or a growth portfolio, maybe the RMDs, like you say, is $3,700 a year. That might only generate, $1,000, $2,000 a year. You're not going to be able to meet that requirement. You'll have to sell shares to meet your requirement. And you back out the fees. In some cases, it's zero. You have no income, and they're strictly growth accounts. So the most important thing is to take that from income.
So, okay, somebody can go, if they have a brokerage statement, to the right-hand column that says yield. They can go down the bottom, and if that number is less than 3.7%, they could pick up the telephone. They call Peak Capital Management, Mike Burleigh in Stuart, Florida, and that's all great. But in the 45 seconds or so we have left, why do you think it is that more financial advisors don't address that issue? They just calculate the distribution, let the client take it from wherever. They don't focus on taking it from the income like you and I do. Why is that?
Well, and the reality is the client in most cases doesn't even know where it's coming from. They don't know it's coming out of a sale of shares of their account. And I think, in our business, the bulk of the financial advisors out there specialize in the growth world. They specialize in stock market-based investments. Let's face it, that's a sexy part of our business. That's the sizzle. Bond or bond-like instruments can be a little boring, but sometimes boring's okay.
So it sounds like that most advisors are content because they're more aggressively minded to spend the principal, cross their fingers and toes, and hope that it grows back. And it's always a pleasure to talk with you, Mike, because you're too smart for that. Thanks for being on the show again. We really appreciate it. All right, you stay with us. We'll be back here in just a moment, right here on The Income Generation.